Welcome to Dotcast Episode 1. I'm Christine, the co-founder of Dot Investing. In today's episode, we will be exploring one of the most exciting and explosive asset classes in investing today, venture capital. If you want early access to tomorrow's hottest technology companies, you need to invest in venture capital now. In this Dotcast, our head of investment, Luke Dixon, and Practical Venture Capital's co-founder and general partner, Aman Verjee, will discuss the evolutions of venture capital investing over the past 20 years. They will also be covering the latest trend in VC investments, as well as what excites Aman in VC today and what keeps him up at night. Aman has more than 15 years of senior financial and operational experience from both private and public technology companies, including PayPal, eBay, and Sonos. Before becoming the general partner at Practical Venture Capital, Aman was the chief of operational at 500 Startups. 500 Startups was one of the most active VC firms in the world during his tenure. Now, without further ado, let's jump into that discussion with Luke and Aman.
Aman, great to see you. Thanks a lot for joining me. Really appreciate it. Looking forward to getting your insights on venture capital over the course of the next 20, 30 minutes or so. Really appreciate it. The first thing I want to ask you, you've been around this industry for a little while. There's a lot of young folks in the VC industry, but you've been around for a while, you and Dave, your partner. What are the biggest changes you've seen in venture capital over the last 20 years?
Well, I think there've been a number of them. 20 years ago, I was kind of a junior employee at PayPal on the finance side. So got to experience some of the venture capital firms as they were evaluating PayPal and thinking about how to help to scale that business. You know, that business went from founding to IPO in 4 years. So it was a very fast success. And a lot of the companies at that time had 3, 4, 5, 6 year exit windows. Now companies are staying private for 10, 15, 17 years. So the amount of capital in the industry and the amount of illiquidity and having to manage those companies through different cycles is very different from what it was back then. I think there's been a number of other great innovations in the space. One is just a number of incubators and accelerators out there that give young founders help and support. There really wasn't anything like that back in 2000, 2001, 2002. We've now had Y Combinator, 500 Startups, we've had Techstars, and just an explosion of these accelerators and incubators out there that are great sources of resource and support and capital for young founders. I think that's led to a very positive change in the ecosystem and a lot of younger fund managers and what we call micro VCs, just funds with less than 100 million, less than 50 million in capital. And now they're all these big mega funds, right? All this late stage capital chasing just a handful of deals. And that's not something we saw 20 years ago, but significant capital being deployed after going after companies with $500 million, billion-dollar and multi-billion-dollar rounds. That certainly was unheard of 20 years ago.
So the evolution has resulted in a lot of capital being available at seed stage, a lot more capital being available to grow and accelerate, and then late stage capital as well. So really everywhere across the life cycle of a small firm, you can get capital, you can continue to grow along with your investors, and that's really changed a lot, hasn't it?
Yeah, for sure. The game has changed. And I think the late stage capital, especially that availability, is a bit of a new phenomenon really of the past 5 or 7 years. And your ability to raise a Series D or a Series E as an alternative to going public and having to deal with the public market overhang, managing the street and managing those investors, that hasn't been around for a while. That's really, I think, more of a 5 to 7 year phenomenon.
I guess dovetailing on that, we've talked about the amount of capital that's come in at different stages, but just the sheer volume of capital flowing into venture capital today. 50 billion, I read, that was raised in the first 5 months of this year, and now there's an estimated 238 billion. I think it's PitchBook data. 238 billion of dry powder available to be deployed today. That seems like a really staggering number compared to the size of these small companies and some of the funding rounds you're getting at seed stage and even later stage. That is an awful lot of money to put to work. How do you think that volume of capital is affecting the way that people invest? And more importantly, how is it likely to affect returns on the back end?
Well, the numbers you're quoting sound it sounds staggering in nominal terms, right? When you say that the amount of venture capital raised, I think last year US VCs at least got 130 billion. That set a record. That was the biggest number in nominal terms ever. And so that makes headlines. But if you think about it, and you don't measure other industries or other dollar amounts that way normally. Like if I told you, hey, the New York Yankees payroll set a record last year. The New York Yankees paid their baseball players more than anyone else in the history of the world, more than Babe Ruth and Lou Gehrig. You'd say, well, sure, but that was back in like 1927. When what the real measure, I think, is as a percent of the economy, or maybe as a percent of like U.S. stock market capitalization. Where's VC at? The assuming that we have another $130 billion a year this year, and it could be more. That's about 0.7%, between 0.6 and 0.7% of the entire US stock market capitalization. And that is nowhere near the record. The record that we set was back in 2000, 2001, or 1999, 2000, 2001. And we were around 1% of stock market capitalization back then. So we're over a 20-year period, it's gone from 1% to about 0.6, 0.7. And we've had some years where we're a little bit less, like 0.4, and some years when we've been around where we are. So it is a lot, and there's no doubt that over the last 2 or 3 years, there's a lot of money into the space. But I think on a relative basis, the asset class is still underpenetrated. I would ask you, why hasn't VC made greater progress? In the last 20 years, we are no larger as an asset class relative to public markets than we were 20 years ago. Like what happened? Why is the industry not bigger than it is? So, I think with all the money heading into the space, it's good in that the ecosystem has a lot of money and resources going after a number of quality companies and managers that are innovating and creating great businesses. I don't think we're, relative to the rest of the world, the rest of the economy, I don't think we're oversaturated. And I think, the investment practices that we've been deploying over the last 20 years will continue to get better and get refined. And I think part of it, we talked about, you have to get better at early, mid, and later stage deals now in order to really manage a fund. You can't just be focused on one sector, because those companies are staying private for longer. So how do you write out, future rounds and dilutions, and how do you co-invest or not? Those are all things that VCs now have to develop and figure out. But I think a good multi-stage investor has the same skills and challenges that they did 15, 20 years ago.
That's really, really good context, actually, given as you say, the size, the scale in nominal terms of the funds that's being raised. A lot's being made of those numbers. As you say, over the last 20 years, actually, we're not necessarily at peak relative to either GDP or relative to the size of stock markets overall. So I think it's good for people to keep that in mind. There could still be plenty of room to grow, and valuations maybe aren't as scary as they might look otherwise. And in fact, as it comes to mind, as you mentioned, that 130 billion, Stripe alone is estimated to be worth more than 100 billion, and that's just one single venture-backed company, albeit it's well into its life cycle, but that's just a single company. So it's good to keep that in mind. I want to bring up one particular manager who I know from the hedge fund world, who's getting a lot of headlines in VC, and that's Tiger Global, who is deploying vast amounts of capital very quickly, and in a way, from what I'm reading, shaking up a little bit the way things are being done in the venture capital world. Can you comment on the benefits and the risks of the way in which Tiger Global is going about their venture capital investing, and the impact that's having on other investors in the space?
Yeah, sure. We followed Tiger and a few of these other strategies. They're definitely trendsetters. I think their approach has been very aggressive, and they're setting higher valuations than what we've seen before. Their management approach and their desire to jump into and actually manage the operations of a business is probably less than some other funds of their size. I think so far this year, they've invested in over 120 startups already. That's what PitchBook is suggesting, and it doesn't show any signs of slowing down. They have a announced $6.7 billion fund. They just announced it a few months ago, and there's rumors that there'll be another bigger one on its heels. So they're putting a lot of money to work in a very scalable strategy, and I think that'll work as long as money is cheap and if the valuations remain strong. And really, that is just a question as whether the public markets will accept that these unicorns and VC-backed companies, and these valuations will sustain. I think they'll do great. They have an approach of a high frequency of investments, maybe a lighter touch, and then just putting as much money to work as possible because they see a market opportunity. In effect, backing the race, not the horse. That is really an approach that my partner Dave McClure pioneered at an earlier stage. He was a seed and Series A investor, and back in 2010, 11, and 12, he did what no one thought was possible. He backed hundreds of companies across several funds, and didn't take board seats and wasn't an active manager in all these companies, but just took a broader portfolio approach. And in an up market, that works great. Those funds have done well. I think Tiger's done great, and I think as long as the valuations in the market are sustainable, they'll do great.
So Tiger's effectively taken a page out of Dave's book.
Yeah, I'm not sure they would agree with that, and I'm sure they're looking for other sources of inspiration. But there are a lot of similarities in their approach and what they've done to what 500 startups had done earlier on.
It does seem to be a stark contrast to the deep value add that a lot of venture capital investors, I think, rely on in making their deals, is that they can add a lot of value to a founder as they grow and scale their business, from advising on hiring and culture to maybe mergers and acquisitions and so on. And they're taking a very hands-off approach. It is, as you say, it's very different. It feels almost like it's an index of venture capital in a way if you're investing with Tiger Global. According to PitchBook data, we're having a lot of PitchBook references here because they're a pretty good source of data and analytics these days in the private markets world. But according to PitchBook data, VC exit value surpassed $300 billion in 2020. And that's more than double what it was in 2018 on similar exit activity. So it's coming back to the original question around sort of nominal values in the VC world today. But it's really big growth over the course of just a couple of years. Do you believe that current valuations and exit multiples are justified, or do these lofty valuations concern you? We've had a couple of examples. Deliveroo's one over here, very popular food delivery service that sort of failed post IPO, and there's been a couple of other notable stories where the valuations did not hold up once the companies went public. So what are your thoughts on valuation today?
Yeah, I think there are certainly examples of companies that go public at rich valuations and then don't trade well. But I think the broader question is: are the public market multiples, are they reasonable? Are they defensible? Is it sustainable, I guess? And is that something that's going to sustain the markets? And if I just step away from some of the examples and think about the overall public markets, there are a couple of ways to understand and evaluate, I guess, whether the markets are reasonable or not. One really good way that I've found has worked for most industries and up and down markets is a cyclically adjusted price earnings multiple. So look at the earnings of the S&P 500 and track it over 10 years. So you've got up markets, down markets, and what is the market cap today as a multiple of that historical ratio? This is an approach that was pioneered by a Nobel Prize winner, Robert Shiller. So you may hear it called the Shiller Index or the CAPE, cyclically adjusted price earnings ratio. Mm-hmm. Today in the S&P 500, it's about 37. And if you look at the historical average of where this cyclically adjusted PE ratio has been over the past 3 economic expansions, it's been between 26 and 29. So if you go back into the 1980s expansion, the 90s expansion, and then kind of 2001 to 2007, it usually starts at the base of that expansion around a high 20s multiple, and today we're high 30s. So I think you can look at that and say we're probably 20% overvalued relative to this historical index. The catch is the interest rates are way lower now than they've ever been. Today, the 10-year bond in the U.S. is barely over 1%. It's sub 1% in parts of Europe and in Asia. The last time we had an expansion from like the June 2009 to February expansion, the bond was about 2.5%. In the early 2000s, it was 4%. In the 1990s, it was 6%. In the 80s expansion, it was 9%. So, rates are just much higher now than they were at that time, or much lower now. And so multiples have to be higher. And so I don't know how to calibrate that, but it certainly seems like the stimulus coming from the Fed and other global banks, it's not easing. Here in the U.S., there's unfortunately, but there is a tremendous amount of political pressure on the Fed to keep fuel on the fire. I think that's coming from both parties, and we're, the chairman of the Fed is Jerome Powell. His next term is up in February 2022. So I would expect between now and then there's not going to be a lot of change. Maybe after that there'll be some reevaluation of Fed policy, but I think that continues. The amount of fiscal stimulus happening in the U.S. and abroad is also unprecedented. Like central governments haven't put this much money to work ever. Not in 2008, 2009, 2010, not prior. Our fiscal deficit in the U.S. is about 15% of GDP. It was sort of 8 to 9% during the Obama years, and I remember a time when presidents were getting criticized for running deficits of 3 or 4%. That used to be in the 80s and 90s. That used to be a big deal. So we're at a whole different scale. Yeah, I probably am dating myself. I've lived through several downturns, and I did actually work for a prior administration. And that was the one that balanced the budget in the late 1990s. So I have a different sense of, I guess, a sensibility when it comes to fiscal restraint than the current administration. But that certainly is creating a valuation scenario where all these markets are getting very expensive. And yeah, I think they are sustainable in the shorter medium term, and so it's justified given all these dynamics of the economy. Very strong U.S. corporate profits performance, slightly higher valuations than normal coming out of an expansion, but given the alternatives and the cheap money, that's kind of predictable, and probably for the next 6, 12, 18 months doesn't change all that much.
Yeah, I think the situation is similar in Europe. I mean, not for the same reasons necessarily. I remember underestimating the desperate or the impact of the desperate measures that governments and central banks were doing. And I think we'd be foolish to think that they weren't coordinated. Central banks were supposed to be independent, but in reality, they've been quite coordinated in the way that they've managed and administered monetary and fiscal policy since the global financial crisis. And Europe isn't in a dissimilar situation in a way, except that I think a lot of the disparate nature of the performance of the economies across Europe is such that it's bound to keep interest rates, much lower for longer than anyone would have previously anticipated. And certainly, on any historical measure, lower for longer is likely to keep markets frothy. And I think it's helpful to understand and to contextualize the valuation that exists in the VC space relative to public markets generally. And sure, assets are rich, but there's very good reasons underpinning those valuations today, and there's good reasons to think that those aren't necessarily at imminent risk. Now, if valuations aren't a big risk right now, where do you think the risks do lie in venture capital today?
So I think valuations are a risk for sure. They're cyclically high, as I said. So we have to be, you have to be thoughtful about the kinds of investments you're buying. There are certain sectors I think that are more affected by the valuations than others. There's certain sectors we like and that we'd be staying away from. There's always company-specific risk when you're looking at the companies and their competitive dynamic and what's happening with technology. I think my partner and I would both consider the macro environment, especially just the Fed unwinding QE, quantitative easing. That would be a macro risk that the markets have to be thinking about. There's also, this has always been true. There's always a risk of regulation and tax increases and breaking up big tech, and these are things we're hearing in the U.S. on from both parties. And I think that's those are all political and systemic risks that you have to calibrate and think about. Other areas in VC, I think there is a lot of fund managers out there that are relatively new at what they're doing. Probably a record in the number of first-time founders that are building businesses. So that is I think that's a good thing. But anytime you've got a space where there's a lot of activity, a lot of first-time, inexperienced fund managers doing anything, there's also bound to be a lot of shakeout and a lot of failure along the way. So I think our ability to calibrate and understand businesses is we've been doing it for a long time. So I like our chances, but we spend a lot of time with with the founders, understanding their, how they think about their businesses, whether they've got the right team around them, whether they can understand and operate really in a downturn. It's relatively easy to build a business when things are going the way they are now. Growing economy, consumer confidence is very high, and then a lot of money chasing these opportunities. But when things turn, how do managers adapt to that adversity? A lot of young managers today just haven't had to deal with it, and so we don't know. But we have our own. We form our view as to how we think they'll manage in up and down markets. So that's the big. That's going to be a big challenge going forward.
I think you've actually partially answered my next question. Was given the nature of your business, which is venture capital secondaries, you're investing in the funds of other managers. Given the sheer number of venture capital funds out there today, some have been around a very long time, notoriously hard to access, but there's a whole new universe of where there's literally hundreds of managers managing small funds. How do you go about selecting those as you think about building a portfolio for your investors?
We're operating with funds that are usually 5 or 10 years old. So our approach is to find a fund where we already know and understand the assets. The fund by then has been fully deployed. So the manager has already made their decisions as to how they want to spend the money. They're probably not doing any more capital calls. They're probably at a point where they're returning capital, not calling capital. So we will spend a little bit of time on the fund manager, but a lot of time on the portfolio. Like, what is it that you've built? What are the companies that you've got? How are they performing? And can we? What's your ownership and your rights in those companies? And then can we get comfortable with what you've built as a portfolio? From year 5 on, it's not that hard to manage a venture fund. It's mostly about exits and liquidations and being responsible about that strategy, but no future investments. So I think our approach, de-risks the GP risk quite a bit. We do have a small number of bets with fund managers that we like at an earlier stage, where we're either seeding their fund or being an early LP. That'll be a very small piece of our fund, but Dave and I are doing it just for fun. We like to do that sort of stuff on our own, and so part of that is because it's fun. It's also great learning about managers and how they operate, and a lot of them. Because I guess Dave and I have been around for a long time, they're looking to us for some advice and some help, and that's always rewarding. We have fund managers we like who are from diverse or underrepresented backgrounds, and we think that they can do great things with a little bit of help. And so if we can help that along, that's all good for us, and that gives us some additional learning and context about the space. And at Founder Startups, we had over 20 fund managers who were generally first-time fund managers, but launched under that brand. So we've done our fair share of legwork in picking and selecting and understanding how fund managers operate and determining what makes a good fund manager versus not a good fund manager.
Switching gears a little bit, what sectors excite you in venture capital now?
Well, there's a few that we like a lot. I think the biggest winners for us have been SaaS, especially B2B SaaS companies, e-commerce. We've both been around the e-commerce and marketplace space for a long time. I was at eBay for many years, and Dave and I were both at PayPal. So we like the enterprise SaaS, e-commerce, and fintech sectors in general as the areas where we think are the winners. There are probably a few that are getting very highly valued and hyped. I think notably machine learning and AI companies, deep tech, some healthcare companies. There's no doubt there's a lot of money going after healthcare now, but the multiples have gotten extremely rich. So those are probably areas where we would probably stay away absent some very compelling and unique opportunity. The reason I like the SaaS companies and e-commerce is I think we're still in the very early innings of how SaaS is playing out. And this category has been grabbing share for many years against more traditional software companies. But even now, cloud spending is no more than 25% of all IT spending. What we saw about 15 to 20 years ago was the first generation of SaaS companies, guys like Salesforce and Oracle, and they figured out a better delivery model. They were able to go from customer hosted to vendor hosted software. So overnight, customers didn't have to bear the cost of these annual upgrades and maintaining their software. And then they also switched over to a better pricing model, just a license fee where you have to pay a monthly subscription fee and you don't have to buy the software or maintain it. And those companies did great. And then we had a second generation of these SaaS companies, probably around 2010 or so. We saw folks like Zendesk and Shopify and Slack, and we saw Zoom more recently, who not only have the better pricing and delivery model, but also made adoption a lot easier. Just a very strong focus on user experience, and they just exploded the TAM of the industry much more than Gen 1 did, and the cost of acquisition for customers dropped. And so that's been another big boom in tech SaaS, and that's kind of been the market to date. But now we're seeing a third generation, which is folks like Twilio and Stripe, and they've made APIs the heart of their business and their competitive advantage. So they are now able to live in and interact with the whole software ecosystem, where they're interacting with all these other providers. And they've turned a whole bunch of very narrow, specific use cases into markets. As an example, I used to run finance for PayPal, and if someone had come to me and said, here's a SaaS solution for PayPal finance, I would have said, well, you're going to have to handle accounting and billing and financial planning and analysis and everything that finance touches, HR and all the rest of it. And there are only a small number of providers who can do that. But today, Anaplan has built a $7 billion business just doing FP&A. And Zuora has done a $1 billion plus business just doing subscription billing. Very, very limited, very, very narrow use cases. But they can do that, and they don't have to take over your whole finance system, and they're easy to integrate because they work with everyone else. And that's never been the case before. So now I think Gen 3 is a whole new wave of SaaS companies that will completely change the way that big businesses run. So we love SaaS, and we love the long-term trends in e-commerce and digitization of retail sales. That's kind of gone from being a nice to have to a must have in the downturn. Every retailer is looking at, how do I make it easy and possible to shop and pay for things remotely? And I think those are, again, big markets with lots of winners over the long run.
We've talked a lot about venture capital in the United States. Are there particular geographies that apart from the US, that you're excited about and active in?
Yes, we've been very active all over the world for a long time. I think back before it was cool, we were making investments all over the world. In our first funded 500 startups, we had 80% of our investments in the US. And by the time we got to Fund 4, where I was one of the fund managers, we were 40% in the US. And we were making a lot of investments in Southeast Asia for sure. We see a lot of opportunity at great valuations there. Latin America, and I think most recently now the Middle East. All those have been great areas where we've seen companies just take what's worked and adopting practices that were working in the US and just translating and localizing their companies for local practices. And whether that's rideshare, food delivery, all kinds of other applications, that's been a very successful pattern. So we've been very active in those areas for a while. Probably the one area where we just will not or have not invested is China. The valuations just seem very rich to us. There's currency controls of money coming in and coming out, and there the government can just do whatever they want to. They can regulate away profits and take away businesses without a lot of checks and balances. So we have a lot of hesitancy and trepidation about China. And then we've been looking at Europe. We've kind of made selective bets, a little bit in the UK, looking at France and Germany. Haven't been terribly active there, but obviously a large market where we think there's a lot of opportunity there too.
You and Dave have managed a lot of top decile funds in the past. How have your investments done? What are some of the biggest names that you guys have been involved in?
The first fund that Dave started back in 2010, it's done great. It's been high 20s net IRRs. They've had a couple of IPOs already. Twilio has been the biggest one from that first fund. There are a few other enterprise SaaS companies like Talkdesk and Intercom, Lucid Software. There's an education technology company called Udemy, which has done great during the downturn. In the second fund, we've had a couple of big exits. Credit Karma is a very big one. They're a fintech company here in the US that provides credit scores, free credit scores, and then tax planning and advice to the whole generation of new consumers, which is great. And then we just had a recent IPO called BarkBox, which is an e-commerce subscription chew toy company for dog owners. I'm not a dog owner, but I'm made to understand dog owners. I guess like parents, they spend a lot of money on their loved ones, and that company's been very successful for many years. And once the pandemic hit and dog owners could no longer go to the mall to buy dog food and chew toys, they all went to a subscription online e-commerce model. And and BarkBox is one of the big winners. So they're now a multi-billion-dollar company on the New York Stock Exchange. Yeah. So, and overall, we've had over 20 unicorns come out of our portfolio, all of which were invested in at the Series Seed or Series A level. So, very happy with the portfolio and a lot of amazing companies, and I'm sure a lot more of amazing outcomes.
What sort of hit rate is that? That sounds like a lot of I mean, a lot of success in those first few funds. Is that unusual?
Yeah, I think the performance of the funds, it's definitely been, the performance of the funds has been great. The overall funds are tracking, the first two funds we did are 6 to 9x up from where they invested. And those are top quartile, top decile type returns. So it's unusually high, but we're seeing maybe 3 to 4% of the companies that we invested in achieve that unicorn exit status. So it's a fairly fairly low hit rate, meaning we're striking out 97% of the time. That's not great for baseball, but it is, it's a pretty good hit rate for venture, as it turns out. If you can hit the ball out of the park 3% of the time and have those kinds of outcomes, the fund math works out wonderfully well, and our investors are up 6 to 9x.
An area that is, I guess, redefining in some sense financial technology is cryptocurrencies, blockchain, DeFi, as it's called. What do you think of those three areas: crypto, blockchain, DeFi? And what's maybe the best way to play that particular trend?
So if you're asking about like the technology that underlies a lot of this, like the blockchain technologies that are being used now to create and then store and manage identity, personal information, financial assets in a decentralized ledger, a lot of that makes sense to me, and a lot of that I think is going to be valuable in managing almost any asset going forward. It's going to change the way that we bank and hold accounts, and reduces friction and operational cost across the whole array of industries. From how I hold my money and how I track my real estate holdings, to just how I move money around and how I interact with individuals. And I think that technology seems to me like it's powerful and lasting and will create a lot of winners. One of the big applications has been cryptocurrency, and I don't really understand the value of cryptocurrency yet. It's not a, there are certainly a lot of people investing in crypto, but I don't have a strong view as to how big that market can get or how valuable it'll be. So I've been a little bit skeptical about playing the crypto boom. I know there'll be a lot of shakeout in that industry. I guess it is an alternative to gold, and maybe can be seen as a digital gold equivalent and a store of value, or maybe an inflation hedge. So there is some merit to the idea of it being a non-centrally not a currency around, not controlled by the central government, but it is subject to all the regulation and all the weirdness that the federal government does to currency. They could use those same laws to control crypto. So I don't know that it's immune to the U.S. government or any other government. If I talk to individual investors about why they like it, I think it's sometimes the argument I will get is, well, it's a electronic currency. It's decentralized. I can put it in a wallet. I can send money, electronically to a friend. I can use it to pay for stuff, not a lot of stuff, but some stuff. And I'm thinking PayPal did all this 20 years ago. You can go to your PayPal account, create a digital account, store real currencies, 6 to a dozen of them, and then pay anyone all over the world. So what is it really that crypto does that changes that? I don't think it's a very strong use case or value proposition case. So I think we'll see a lot of volatility and a lot of shakeout in crypto. And I think it's kind of better to be aligned with the technology builders, the blockchain providers, and the picks and shovels makers, rather than any specific crypto.
Non-fungible tokens, NFTs. What do you think of that market?
I guess it depends on the underlying asset. It's as a means to an end. It's an excellent way to track and record ownership, and to make that more efficient, more transparent, more transferable are all great things. Just depends on what the underlying assets are and what you're holding, whether that is something of value and is sustainable. So I think conceptually, very good, and the technology can be very good.
Do you own any?
I don't. I haven't really. I guess I haven't spent that much time on it, so I don't know. I don't know what I would buy as a as an underlying asset. If it's like the rights to Lawrence of Arabia's revenue stream, or something like that, that's pretty good. But I'm historically burned because I used to own baseball cards in the US, and now my baseball card collection is worth, I don't know, 1/10 or 1/100th of maybe what it was in 1992. So you just got to go into that stuff with with a grain of salt.
Man, I put in a joke one there: Elon Musk versus Peter Thiel, who wins in an arm wrestle? I mean,
I think I haven't seen Elon recently. I know that Peter has been trying to do some HGH and human growth hormone. So I'd probably take Peter right
he's
now.
pumping up like Sylvester Stallone.
I think he is. I think he's trying to live to be 120 years old and have a good, long, healthy life. I think that's his goal. So I don't know that he gets as buff as Sly, but I think he does just fine in an arm wrestle with just about anyone.
Saying it sounds like you'd probably put your money on Peter Thiel.
I think so.
As you're investing today, Aman, is there anything that keeps you up at night?
No, I don't think so. I've been doing this for a long time, so I've had the benefit of having made a lot of mistakes and learned from them and learn not to let them bother you. I do kind of worry about cyclical valuations being high and broader market just things priced for near perfection in terms of execution, but also political risk. That's always a tough one to handicap. And luckily in the US we have a lot of checks and balances and a lot of democracy. So a lot of things move slowly, and that can be a really good thing when it comes to how these markets are done. But yeah, I think those are things that every investor has to worry about. Great. Thank you, Luke.
Thank you. Yeah, I look forward to joining you on this journey.
Very good. Appreciate it.
Cheers, man. Take care.
Bye.
Bye.
I hope you will enjoy our first ever Dotcast today. We would love to know what you think about venture capital investing in the post-pandemic world. So please do send us your feedback in the comments below or email us at dotcast@dotinvesting.com. If you're interested in learning more about private markets, venture capital, or how dot investing can help you diversify into private assets, please visit our website at dotinvesting.com. See you at the next Dotcast.